In an unexpected turn of events, Canadian pension funds, once major investors in US markets, are now dramatically pulling billions of dollars from American assets and funneling that capital into Europe. This mass exodus marks a significant moment in global finance, signaling a potential shift in the economic power balance. The Canada Pension Plan Investment Board, CPPIB, and Ontario Teachers' Pension Plan, OTPP, are leading the charge as they reallocate their portfolios away from US assets to safer, more predictable investments in Europe. For years, these funds have been pillars of US capital markets, but now they are voting with their dollars, signaling a profound loss of confidence in American leadership under President Donald Trump. His tariffs and trade policies, introduced earlier this year, have triggered more than just trade tension. They've sparked an investor revolt. So why are these massive institutional investors choosing Europe over the US? How far-reaching will this capital flight be? Let's take a deep dive into what's happening behind the scenes and what this means for both the US and Europe's future in the global financial system. Before we continue, make sure to like this video, subscribe, and ring the bell to stay updated on more insightful global financial analysis, brought to you by the African Web Channel. The answer to why Canadian pension funds are abandoning US assets is tied directly to rising instability in Washington. Under the current Trump administration, the tariffs, particularly those slapped on Canadian steel and aluminum, have alienated some of America's closest allies. What started as a trade war against China quickly spilled over into America's trading relationships with Canada and other nations. The result? A growing uncertainty in US economic policies that makes long-term investing risky. The unpredictable nature of US policies, particularly with the ongoing shifts in trade, taxation, and regulatory frameworks, has made long-term forecasts difficult. This uncertainty, amplified by contentious political debates and policy reversals, has led many institutional investors to reconsider the risk of maintaining large stakes in US assets. As a result, Canadian pension funds are prioritizing countries with more stable governance and economic outlooks, further accelerating the movement of capital to Europe. The tariffs implemented by Trump in 2025 are viewed as more than just trade barriers. They are seen as a fundamental shift in how the US approaches its international economic relationships. These tariffs have injected unpredictability into the market, making it hard for institutional investors to trust in the stability of US policies, especially with the looming uncertainty about Trump's second term. The consequences are clear. Investors are now more hesitant to expose their capital to an unpredictable political environment. Meanwhile, Europe, despite its own set of challenges, including inflation, energy crisis, and some political fragmentation, has become a safer haven. European markets, particularly private credit and real estate, have been attracting the attention of Canadian pension funds. These investments are seen as more secure because they operate within a framework of stable regulatory policies, long-term fiscal planning, and a coordinated response to economic challenges. The S&P 500, the US flagship stock index, has been on the decline, while European and Asian markets have shown more promise. As European markets continue to perform better, investors are starting to reconsider where they put their money. For these Canadian pension funds, the shift to Europe is not just a reaction to tariffs, but a calculated, strategic move to safeguard their investments from greater instability in the US. As Canadian pension funds move their capital out of US assets, another critical factor contributing to this trend is the decline of the US dollar. The tariffs imposed by Trump and the subsequent retaliation by trading partners have caused ripple effects in global currency markets. The dollar's strength, which had been a cornerstone of American economic power, is now weakening, leaving investors questioning its stability. With this devaluation, many international investors are looking to alternative currencies, and the euro is increasingly seen as the safer bet. The shift toward the euro represents not just a desire to diversify portfolios, but a recognition that the dollar may not be the reliable reserve currency it once was. This weakening of the US dollar signals long-term implications for global finance. It could lead to a rebalancing of the international monetary system, with the euro gaining ground as the preferred currency for global transactions and reserves. The implications of this are vast. If the US dollar continues to lose its dominance, countries may begin to move away from dollar-based transactions, opting for the euro or even other currencies. This shift could undermine the US ability to influence global trade and could create new economic alliances, with Europe potentially emerging as a central player in the global financial system. The most significant fallout from Trump's tariff policies and the subsequent movement of Canadian pension funds is the broader loss of global confidence in the US, as pension funds, traditionally some of the most conservative and risk-averse investors, start pulling out of US markets. It sends a clear message. The world is no longer certain that the US is a safe place for investment. This isn't just about capital flows, it's about trust. Trust in the US economy, its stability, and its ability to engage in predictable, fair trade policies. This growing lack of trust is mirrored in the shifting behavior of multinational corporations. Increasingly, businesses are choosing to expand into Europe rather than the US, seeking to benefit from stable policies and predictable growth. This movement is a direct response to the growing volatility in Washington and the changing dynamics under Trump's leadership. Europe, with its stable political environment, clear economic policies, and predictable regulatory landscape, is now the preferred destination for capital. It's no longer just a market to watch, it's where the world's investors are putting their money. The European Union's consistent economic policies and its commitment to sustainable growth have made an attractive alternative to the US for multinational companies and institutional investors alike. The shift of Canadian pension funds from US assets to Europe marks a pivotal moment in global finance. Trump's tariff backlash and the growing instability in US political and economic policies have driven this exodus, but the consequences will stretch far beyond just one country or region. The decline of the US dollar and the rise of European investment opportunities signal the start of a larger, more profound transformation in the global economic order. What does this mean for the future of US leadership in global finance? Is America prepared to confront these challenges, or is it already losing its grip on economic dominance? As Europe gains ground and the US loses its appeal as the go-to investment destination, the global power dynamics are shifting in real time. Could this be the beginning of a new era, one where European markets gain increasing influence, and the US must adapt or risk falling behind? We want to hear your thoughts. Do you think this trend will continue, or will the US find a way to reclaim its status? Can Europe truly replace the US as the world's financial leader? Share your opinion in the comments below. We love hearing your perspective on the changing tides of global finance. If you found this video insightful, make sure to like, share, and subscribe to the African Web channel for more thought-provoking content on global economics and politics. Don't forget to hit the bell icon so you never miss an episode that impacts your world.